Welcome to another video. In this one, we'll be talking about companies, the cons or disadvantages, and the pros being the advantages of operating a company. So the first disadvantage or con is the losses are trapped in a company. So if you make a loss in a particular year, whether it be capital or income on revenue account, you can't pass that loss onto somebody else. You can't pass it onto another entity. It's trapped. You have to wait until you make either a revenue gain or a capital gain to be able to offset those. This is a bit complex, and that can be left to another video. We can speak about it in more detail in terms of how these losses are applied. The next one is tax rates. The company, where it's a trading entity with what they call base rate entity income or base rate income of 20% or more, is able to be taxed at 26%. That was for the 2021 financial year. But from the 2022 financial year onwards, the tax rate is 25%. Now, where the base rate entity income is less than that, that is, it's less than 20%, then the entity is potentially taxed at 30% in the dollar for every dollar. So that's something that we need to be mindful of. It's not 30% or 25% when you get up to a certain income threshold. No, it's from the very, very first dollar. Moving on, the 50% capital gains tax discount, where you hold an asset for 12 months or more, that's not available in a company structure. It's not available. The next one is franking credit refund. If there's excess franking credits in a company, that is not refunded, generally speaking. That needs to be converted into a loss. Well, the issue is that you can't get a refund in that particular period, so you can use those dollars for whatever purposes that you want to use them for. Next one is director liabilities. Because of the Corporations Act, directors who are negligent can be held both criminally or civilly liable for various actions or shortfalls. Okay? What else? Loans from an entity. Where you take a loan from a company as an individual, you may be subject to Division 7A. What does Division 7A mean? Well, Division 7A was put in place really to ensure that people don't pull funds out of a company, use it as income without properly being taxed on it. What does that mean? Well, it means that Division 7A will deem a loan from a company to be a dividend, and an unfranked dividend at that, which means if you have franking credits attached to a dividend or could potentially be attached to a dividend, you can't access those franking credits to reduce your income tax liability. So that's a huge, huge penalty potentially for a company that has quite a lot of dividend or franking credits that it can access. Now we're going to move on to the pros or advantages of using a company. And the first one is limited liability. What does that mean? We mentioned it in a previous video when we were speaking about setting up a trust with a corporate entity. That limited liability means a creditor cannot potentially go after your assets if they don't have any more assets within a company. Again, that is subject to the directors or the personnel of the company abiding by the relevant laws and regulations and not being criminally negligent. The next benefit is what they call research and development incentive. So The research and development incentive is provided by Aus Industry Australia, and you get this when you lodge your tax return. It's really a benefit provided to organizations, companies that are conducting research into various services and products which they can provide to the market. So that's generally 43% of the research and development expenditure, subject to various rules. Again, this is complex and would need another topic and video on its own. The next one is equity and shareholding. In a company, what you can do is you can potentially list on the Australian Stock Exchange. That is subject to you issuing a prospectus explaining what the projected income, liabilities, so on and so forth are for this particular entity, the project you're conducting, the activity that you are operating on a day-to-day basis, and you can generate income through there. Alternatively, what you can do is you can go out directly to various individuals and ask them if they'd like shares in your company. Generally, there should still be some kind of document to show these investors what your activities are about. Otherwise, it's very unlikely that they'll invest in your company based on no information whatsoever. The next one is the tax rate. This is where the tax rate can also be an advantage. For example, instead of being taxed as an individual at the highest marginal tax rate of 45%, what you can potentially be taxed at is, again, either 30% or 25%. So you can see how that's quite a huge saving. The next advantage is access to the small business entity concessions. We mentioned this in another video, and they include things like the 15-year exemption, the 50% active asset reduction, the 500,000 superannuation exemption, and finally the roll over into another asset, which needs to be an active asset. Next, we have income splitting. Well, you can't income split as effectively as you can if you use a discretionary or family trust, but you can income split within various shareholder or share classifications. For example, there are ordinary shares, there are Class A shares, Class B shares, and you can go all the way up to Class Z shares. You also have preference shares, but generally they don't have voting rights. So you can see that you do still have some flexibility in distributing, but again, you need to be very careful with these distributions and having these various share classes, because that can have huge implications down the track when you are trying to access the small business entity capital gains tax concessions. It's a very, very complex and wide area, and you definitely need to plan ahead well in advance. We're talking about, potentially up to 5 years down, 5 years ahead. The next one is retention of income. Why is this important? Well, you get taxed at say 25%, and that income can be retained. Generally speaking, in a trust environment or in a partnership environment, that profit needs to be distributed to the members, but you can still retain the profit to some degree by giving the amount that is allocated to you back to the organization as a loan. The last one is estate planning. Well, it's quite simple. What you can do is in your will, you can pass your shares in a company to your descendants, or you can potentially pass it over to a non-for-profit organization. So again, there's quite a bit of flexibility there in terms of operating as a company. I hope this video was helpful to you. As always, leave a comment letting me know if you found it particularly useful, what your insights are, what you'd like me to cover in the future, or any feedback as to how these videos can be improved. As always, I hope you have a great one, and we'll see you in the next video.